Okay, good evening, everyone. Thank you so much for joining us today. My name is Gabriela Farias. I am the head of revenue for the Global Wealth Group. Joining us this evening is Matt Johnson, the managing director for the McFarlin Group, a new sponsor with us both for our Wealth Migrate marketplace and our recently launched Private Wealth Group marketplace. Today, Matt will be speaking over the McFarlin Senior Care Living Fund, which is a new investment opportunity that can be found on both of our marketplaces. I'm personally very thrilled to welcome McFarlin on as a sponsor and very excited personally about this investment opportunity. So thank you again to everyone for joining us. Matt, any words before we get started?
Thank you, Gabriella. Thank you. Want to confirm you can see my screen?
I can, yes.
Okay, great. Well, good afternoon, good morning, depending on where you are in the world. My name is Matt Johnson, principal and founder of McFarlin Group, and look forward to the webinar. Gabriella, I'll let you kind of walk through disclaimer.
Thank you so much. So this deal is listed on both our Private Wealth Global Marketplace and our Wealth Migrate Marketplace. This is a simple disclaimer to say that any advice to advise that you retain any obtain the advice of a competent financial advisor before investing in any financial instrument or product. And we strongly recommend that you consult with a licensed financial professional before using any information provided during this workshop. However, very glad that you are joining us, and please understand that the information relayed here is entirely informational in its nature. We can get started, Matt, on discussing this fund, discussing McFarlin, and then discussing this opportunity. So great. I'll let you take it away.
Thank you. And Matt Johnson, Managing Director, Founder, and Principal with McFarlin Group. We're based in Dallas, Texas. So it's around 11 o'clock a.m. here. And wanted to give a brief overview of the McFarlin Group today. A little bit of background on not only us, but the senior housing industry and the current state of the industry, and the distress that we're seeing in the industry caused and deepened by the pandemic. And then a brief overview of our fund investment opportunity that we're working with Gabriella and the Wealth Migrate team on. So McFarlin Group is a fully integrated senior living firm, meaning we are a developer, owner, and we are an operator of senior living communities. So that's what we're calling fully integrated. We have an expertise in identifying, evaluating, and acquiring and overseeing and adding value to senior living assets. My two partners and myself make up our investment committee, and the three of us have 59 years combined experience in senior living. And over that 59 years, we've completed around $2 billion in total transactions of development and acquisition opportunities. I founded the company in 2008 here in Dallas, Texas. Currently have around 11 corporate employees, and within our management company, Surpass Senior Living, we have around 370 employees. On properties that we've gone full cycle, where we've either built, acquired, and ultimately sold, we've generated a return of 28% IRR for our investors. And in our new fund vehicle, we'll be committing around $5 million of our own money in the deal, which we'll get to at the end. We've raised money on a deal by deal, transaction by transaction basis in the past, around 104 million US dollars, which represents around $500 million in total project costs. And as I mentioned, a realized net 28% IRR and 2.25 multiple to our investors on prior transactions. And so we are raising a fund vehicle for distressed opportunities within senior living in the US. And so I wanted to talk a little bit about the current state of the senior housing market here in the US and why is there distress? Where did that distress come from? So as you can see from the chart, this is construction and development activity of new units in the top 31 metropolitan statistical areas. So basically the top largest 31 cities in the United States. And as you can see, coming out of the Great Recession, there was considerable development activity starting in 2013. So there was a lot of migration from other developers into senior living, all chasing the strong yield profile that they can earn for investors in senior living assets. In addition, the powerful demographic trends, the graying of America, the senior tsunami, the age wave led by the baby boomers who today were born in 1946 to 1964, which means they're 57 to 75 years old right now. So unprecedented development activity from 13 to really mid 2019. We saw a cap around January, February, Q1 2018, and then construction started a little bit of a decline. So we were building around 8 to 10% of total supply for a number of years. So what happened as a result of the construction activity in 2013 to 2018, you can see tracking the orange line, which represents licensed assisted living and Alzheimer's care in the United States. You can see a decline in occupancy from 2013 to 2018, which is inversion of the amount of construction activity. The prior decline, 2007 to 2009, that was Lehman Brothers, that was the Great Recession, and seniors couldn't sell their homes, and we saw a decline in occupancy in assisted living and memory care, again, the orange line, from 90% down to 87%. And then we saw the recovery back to 89% over about a 4-year period, and then a decline in occupancy as a result of the significant amount of new construction activity. And then COVID occurred and started having an impact on senior living occupancies in March of this year. And as you can see, we've had around a 7 to 8% decline in occupancies in 2020 as a result of COVID. So our industry in the United States is relatively new and really institutionalized itself in 2006. So we've tracked occupancy as an industry here in the United States since 2006, and you can see how the occupancy dipped during the Great Recession, started to recover, started to decline again because of supply-demand imbalance, and now the significant decline because of COVID. And so we like to say that COVID didn't cause the distress, but it is contributing to and is deepening the distress within senior living. It's really expanded the distress, especially for those properties that were built in the last 3 to 4 years in markets that have too much supply. So prior to the pandemic, prior to March of 2020, those properties were having a hard time leasing up and filling up their beds. And so occupancies were at a point where they weren't covering cash flow, and they were in some level of distress because of supply-demand imbalance in overbuilt markets. And then the pandemic has declined their occupancies another 7 to 8 points. The primary reason for COVID having a impact on occupancy is a number of factors. Number one, families pulling their loved ones out of assisted living because of the threat or concern that mom or dad could contract the virus within the walls of the senior living community. So we saw people pulling their loved ones out. We also saw families delay making a decision to move their loved one into assisted living, and more people working from home able to provide care for mom or dad in their home during this time period. And then lastly, within the Alzheimer's market, we haven't seen as much of a decline over the last year because if your mom or dad, your loved one has Alzheimer's disease, it's really hard to move them out of a senior living community or delay moving them in because they could be a wander risk. They may have behavior issues, and caring for them at home really isn't an option. So most of the decline that we've seen has been concentrated in the assisted living side of the market over the last year. But again, tracking the orange line on this chart, which is assisted living and memory care occupancy across the United States, you can see all levels of care, independent living, nursing care, and assisted living all declining. But a majority of the construction overbuilding occurred in the assisted living and memory care space. So there's a compounding effect of distress because of overbuilding in certain markets in the US where occupancy was already declining, and now the decline in occupancy because of COVID. Despite the distress that's occurred in the space, the long-term demographic tailwinds are extremely favorable in senior living. The unprecedented age wave, which is coming, and that's led by the baby boomers. But as I mentioned, the oldest baby boomer in the United States turned 75 on January 1st this year. And our typical resident in assisted living and Alzheimer's here in the US is around 80 to 82 years old. So we'll see the effects of the baby boomers over the next 5 to 7 years, but they're not quite at the age group, which represents our typical resident population. But as you can see, the growth from 2020 to 2025 and 2025 to 2030 is significant, that will be increasing the 80 and older population at around 40% just over the next decade. And then it continues to compound thereafter. So it's the fastest growing segment of the population in the United States is the population age 75 and older, which is led by the baby boomers. Another determination of long-term demand is a study that was done by some long-term veterans of the senior living industry here in the United States. And it really provided an estimate of the amount of inventory that will be needed between now and 2040 if today's penetration rates hold into the future. So using population estimates from the US Census Bureau for the next 20 years, they estimated what the need will be over this 20-year period. And so as the graph presents, we'll have a need over the next 5 years from 2020 to 2025 of just under 60,000 units per year. And then over the following half decade, 2025 to 2030, around 93 to 94,000 units per year. So into the future, many industry experts and veterans are anticipating that we'll need a lot more new construction just to keep up with the demand for senior living in the US in the future. Even if we see lower demand for senior living because of concerns raised during the pandemic and because of technology that allows seniors and families to stay in their homes a little bit longer, the demand need is still very strong over the next decade. And the demographic trends are obviously extremely powerful and unprecedented. This graph presents on a 10-year basis ending Q3 2019. It presents publicly traded healthcare real estate investment trusts for which senior living and healthcare properties are a part of their portfolio. It shows that it outperformed the NCREIF, only behind industrial, over a decade of generating solid returns. So it's outperformed retail, office, hotel, and apartment over the last decade. And NCREIF, the NCREIF, is an acronym for the National Council of Real Estate Investment Fiduciaries. It operates as a nonprofit entity here in the United States, and its goal is to inform parties and individuals and investors on the actual performance of real estate industry so that they can make informed investment decisions. So it's a third-party nonprofit organization tracking investment returns across real estate. So senior living over the last decade has performed very well in comparison. A few assets, I'm going to skip ahead and talk about our fund first. So we're working with Gabriella and the Wealth Migrate team to raise a fund focused on acquiring distressed senior living assets here in the United States, with an emphasis on acquiring loans from lenders at a discount to cost, or a discount to the par or principal balance of the loan. We aggressively pursue foreclosure to own the real estate. And then we add value over a 4 to 5 year period in terms of occupancy growth, reinvestment in the property. If there are any capital expenditures needed, like carpet, lights, furniture, roofing, HVAC, we can make those investments so that we have a type, A quality physical plant. So add value over a 4 year period to drive occupancy as the baby boomers continue to age and we get through the pandemic and lease up the properties. And then we aggregate all the properties, which we anticipate somewhere between 10 and 20 properties that we aggregate into one or more institutional portfolios, and then exit the portfolio in around 5 years. Our target is to return a 20% IRR to the fund and its investors over this 5 or 6 year time period. And what's crucial to the 5 year hold period is that in 5 years, as I mentioned, the baby boomers will be turning 80, and they will be providing a lift to occupancies within senior living because there will be more people of age, which represent our typical customer in assisted living. We also believe that there'll be more global demand from private equity to buy senior living assets in the United States in 5 years, which is at the beginning and start of the significant demand shift in the United States. So we think it'll be a very good time to be a seller. And in my 2 decades career in senior living here in the US, I think now represents the best opportunity to be a buyer of senior living. So an example of 2 assets that we have purchased that we contributed to the fund. The first one is a 50-bed memory care Alzheimer's facility in Houston, Texas. The loan had an outstanding balance of $8.7 million. We acquired the loan from the lender for $4 million. The occupancy at the time of acquisition of the loan was just over 70%, and the property wasn't producing cash flow. The lender had not been paid, and property taxes had accrued for a period of around 2 years. So the property was built. It's a newly constructed property. This market segment of Houston, the west side of Houston, was overbuilt. There was too much Alzheimer's product delivered at the same time. And so occupancies were not able to increase to 85% stabilized levels. They were increasing at a much slower pace. So providers run out of working capital and they don't have enough operating income to pay their loans current. They capital call investors, and the investors decline to fund, and therefore the accrued interest and principal to lenders continues to stack up and accrue. Lenders don't want to own senior living because of the liability and ownership. They don't want to fund working capital for food, labor, property taxes. So we find that lenders will sell the loans at a discount to the current principal balance. And so that's where we acquired the loan for 46% of the principal balance of the loan. The total cost to build this property was around $13 million. So the equity is wiped out and we foreclosed on the property. We actually took ownership of the property January 28th of this year. So it took us around 6 months to go through the court process to acquire the property. And now we are the owner of the property. And our intent is to lease the property up and aggregate it and sell it in a portfolio. Since we acquired the loan in June of 2020, as the lender, we were having weekly calls with the operating team to help drive value in the asset. And I'm happy to report that today occupancy as of the end of December was 89%, so up from 70% when we acquired the loan. And the property was, at the time, averaged around $30,000 in losses per month. And in December, we had $37,000 in profit for the month. So we're already adding value as the lender, and we intend to continue to add value as we take ownership of the property. Second asset that we acquired within the fund was not a senior living asset, but a healthcare asset in Portland, Maine. It was a medical office building. It was a $4 million, just shy of $4 million balance loan that we acquired at 14% of par. We acquired it for $575,000. We pursued multiple strategies, including releasing the property, possible conversion of the property. But after closing, we received a deed in lieu of foreclosure from the owner, and we received an unsolicited offer to acquire the property. So we exited the property, and fund investors received a 505% estimated IRR and around a 1.57x cash multiple. So a nice win early in the fund. Our focus will be senior living, but we will be looking at unrelated healthcare facilities as well that we can acquire and realize value for our fund investors. The structure of our fund, we are a Delaware limited partnership here in the U.S., which Gabriella and her team can certainly answer questions about the structure for Wealth Migrate investors. But we are targeting to raise $100 million. We've got great progress today. We have a lot of friends and family here in the United States that have invested alongside of us. Fund investors will earn a 10% preferred return. It accrues. We don't expect any distributions for at least the first 2 to 3 years. As we're buying distressed assets, they don't produce any cash flow. So don't anticipate any distributions for at least the first 3 years. But preferred return accrues at 10%. Once investors receive a return of their principal balance and a 10% preferred return, then there's an 80-20 split with the general partner sponsor. Investors do have a 12% look back on the IRR, meaning that if investors don't get a 12% IRR overall, then we won't participate as the sponsor in any profits. We will be investing $5 million of our own money into the fund, and we believe that creates a lot of alignment, skin in the game with our fund investors in this first fund of ours. We have a number of third-party providers working alongside us. We will be producing annual audit and tax returns, which will be available to all investors. So with that, Gabriella, wanted to see if you have specific questions, or if any fund investors or prospective investors have any questions. I'd be happy to address those now and
Yes.
Get into any more details if needed.
Yes, definitely. Thank you so much for that overview, Matt. I think it's very helpful for myself and for our investors to see that fully and presented by you. I do have some questions right off of the bat that I want to address with you. So can you speak to, with this fund, the regions that you're targeting? I see that you have already acquired that property in Houston and then a property in Maine. Is there a specific region that you are planning to target for these distressed assets, or a region that you anticipate will be fairly popular for assets to be acquired within this fund?
So we will cover coast to coast, continental United States, but we do believe there will be a concentration of distress in the Sunbelt states, which are the southern states in the United States, which includes Florida, Atlanta, Georgia, Texas, the markets Dallas, Austin, Houston, San Antonio, Phoenix, Arizona, Denver, Colorado, as these markets in the south, southwest, southeast, prior to the pandemic, had declining occupancies as a result of overbuilding. So they're strong fundamental markets, which is why we like them for investment, but they are experiencing temporary supply-demand imbalance, because a lot of developers all saw the same trends and demand need for senior living in these markets, and they all built in the same markets. And therefore, there's temporary distress because of supply-demand imbalance. And it'll take several years after the pandemic for these markets to absorb all those new units that were provided as inventory over the last 3 to 4 years. But we believe that
Sure.
these are really solid markets for ownership over a 5 to 6 year period because they have strong job growth, which is driving the 45 to 6-year-olds to these markets. And then when their mom or dad or a loved one needs assisted living or Alzheimer's disease, they generally move their mom or dad from other regions across the United States to where they are, and they select an assisted living community nearby them. So
Right.
that's why these markets received a lot of development over the last 5 years because of the powerful demographic drivers of the adult child population ages 45 to 64 and because of job growth.
Right. Okay, great. Thank you. And you mentioned this just now briefly, but if you can elaborate on the property types that you are targeting, is there a preference in terms of weight for independent living, assisted living, or nursing care in the assets that you're looking to acquire for this fund?
So we will cover senior living assets across the continuum, which means active adult, independent living, all the way through skilled nursing. But our primary area of focus, where we believe we'll see most of the distress and where we feel most comfortable, is in the private pay, assisted living, and Alzheimer's market, principally in the Sun Belt states, but really coast to coast. And that's where we believe we'll see most of the distress, Gabriella, because that's where most of the development activity occurred over the last 5 to 7 years since 2013, is in the private pay, assisted living, and memory care market.
Right, right. Okay, great. And in terms of the communications that our investors can expect from McFarlin, what will that look like? So what will you communicate with us as you acquire properties, updates on the fund? Can you just give us a sense of that?
Yeah, we have institutionalized ourselves over the last couple of years, and we have a investor portal. Within the investor portal is where we will post all of our status reports and updates and other key information. We will, per our mandate in the fund, produce quarterly status reports with financials and sufficient details on each of the investments. And then we make periodic email updates through our investor portal on our pipeline and assets that we may be looking at, considerable or significant events that may have occurred within the quarter where we don't want to have to wait to post those in a quarterly status report, or we want to highlight something before or after publication of a quarterly status report.
Great. That's wonderful to hear. I do want to ask or inform those that are in this webinar with us live. If you have questions, please direct them to the Q&A box for Matt and I to address. Matt, I do have another question on leasing. So you mentioned the asset that you acquired in Houston. You were able to increase that tenant or that occupancy, excuse me, to 85%. Can you talk a bit about the tenants that you seek for, or you will be seeking for the assets that you are acquiring for this fund?
Yes, so our primary focus is private pay assisted living, and unlike other countries and other markets that may have other government payer sources, we're predominantly private pay here in the United States until a senior spends down all their assets. Then they may qualify for what we call Medicaid. So we're really focused on private pay senior living. Our typical resident is 82 to 80 or 80 to 82 years old. And those residents generally move to assisted living or memory care many times after a triggering event. It may be a missed medication or a fall or something that requires a hospital stay. And then there's intervention from family and primary care physician where there's a strong recommendation to move to assisted living. So we spend a lot of our time marketing to physicians, rehabilitation facilities, social workers, and presenting ourselves as an option to assist their clients and customers. So we get a lot of our referrals from the medical community. And then those that are suffering from Alzheimer's disease, generally, they're going to a psychiatric physician who is diagnosing them with maybe some early stage of Alzheimer's or dementia. So we do spend a lot of time marketing to physicians with a specialty in psychiatry that may be seeing seniors that are developing Alzheimer's disease. And so we get a majority of our referrals from those sources. We're spending a lot more money and time um, refining our digital marketing campaign. As a adult child, 45 to 55 years old, relies on computer, internet, and phone for research into assisted living or Alzheimer's care facilities. So we do spend a lot of time trying to refine and perfect our digital marketing strategy as well to get in front of customers.
Sure. I think that touches on something that we haven't fully or made fully explicit, and that is when you take on these properties, who is managing them? Because it sounds like you or McFarlin rather is doing a lot of the legwork to find the tenants, but who is managing the day-to-days of these assets?
So we do have our own management company based here in Dallas. We do manage an asset in Atlanta, in Texas, and in Phoenix, Arizona. But senior living is very localized and regional. Each state has a different set of regulations, and the product within senior living is really the people. So we will rely on and hire and oversee, direct and coordinate a local operator to oversee every property that we own, as we believe that regional operators understand the regulatory environment and the labor market much better than we can from Dallas. So we will hire and select an operator in an area like Florida because they understand that market. In addition, they may have other facilities nearby and they can share resources and create some synergy in operations of those facilities. But because we are owner and operators, we really understand senior living operations and believe we're uniquely qualified to add value as an asset manager overseeing another operator if our management company is not operating. And as we like to say in our office, if you want better answers, ask better questions. So we really have refined and know what questions to ask of an operator that's overseeing one of our investments to ensure and make sure that we're maximizing the probability of success.
Great. I'm going to switch now to a question from some of our attendees. So Mark is asking if you can just review the acquisition of, I believe it's the Houston property and that 500% return, and just going over that a bit more. What does that mean for the investors that invested in that, or for the fund rather?
Yes, so our fund acquired the loan. This was in Portland, Maine. We acquired the loan for $575,000. We have unrelated soft costs to pay some operating expenses, to take ownership of the asset and to sell the asset. But we ultimately sold the asset for $1.25 million. And so net of costs, our investors in the fund earned a 1.57x cash multiple. So yes, that's correct. That the fund invested, in this example, invested $10,000. About 4 months later, it got around 15,700 back, which equates to, over that short time period of 4 months during our ownership, to a little over a 500% IRR. So the question that is posted is correct. It's pro rata for fund investors. So all fund investors at the time that were invested in the fund would participate in the profit from this community.
Okay, wonderful. Thank you for that. We do have a question, I think it's asking to explain the returns again. So Matt, if you can go back to that slide, and I will also just contribute from the Wealth Migrate and Private Wealth Global standpoint. So when we are considering the hurdle rates and the projected IRRs, please keep in mind that this will be, your investor fee will be reduced from this dependent upon the marketplace in which you invest. So if you are an investor on our Wealth Migrate, marketplace that is a 3% investor fee for whatever you decide to invest into this particular fund and this particular opportunity. For those that are interested in joining our private wealth global marketplace, we do offer a 2% investor fee if you've joined this month or after February 1st. I would encourage you to reach out to your wealth consultant, to myself or to Lee Rush directly for additional information here and maybe more of a personalized response for you depending upon the amount that you are interested in investing in.
Sure, and Gabriella, 2% is a great fee. We have other investors that have invested in the fund through other third parties, and the fees that they will be paying to that third party exceed 2%. So I think that's a fantastic structure for your investors. So the structure again is a 10% preferred return, and then a 80-20 share of proceeds thereafter. So investors, the flow of funds or waterfall is such that investors will receive a return of their capital first. So if an investor invested $100,000, all the money that comes back and is returned to the fund through distributions or through the sale of assets will first go to all the investors pro rata until the investors receive their $100,000 investment back. Then all the proceeds will go to investors pro rata until they receive a 10% internal rate of return on their capital as calculated. And then thereafter, the third waterfall is an 80-20 share of proceeds. 80% of all the proceeds go to the investors and 20% go to us as the fund manager and sponsor of the fund. And then there is a 20% IRR look back. So if investors have not received a 12% IRR when we close the fund, we will contribute capital that we have earned along the way back to the fund to ensure that investors get a minimum return of 12%. We think this is an attractive structure for investors, given it's a first-time fund. Many fund 2, 3, 4 here in the US have an 8% preferred return and a 80-20 or a 70-30 split. So we think a 10% preferred return with a 12% IRR look back and our significant investment is pretty attractive for investors for a first-time fund.
Sure. I see a question here from
I
Rachel.
should clarify as well, Gabriella, that this is a 6-year closed-ended fund. So there, as opposed to many funds that are structured as a 10-year fund or an evergreen open-ended fund, this is a 6-year fund. So from the time we opened the fund, which was August 21st, 2020, it has a 6-year lifespan. We do have a few optional 1-year extensions to that in the event that we have a few assets that we haven't sold, or if there's another pandemic and it's just not the right time to sell, that we have a few extensions to that. But our goal and intent is that we close the fund within 6 years so that investors know that their capital is not tied up for a significant period of time beyond 6 years.
Great, thank you, Matt. And I think just to add to that, or to further to dig deeper into that, is there any possibility that the investment might be shorter than 6 years, dependent on the movement of buildings purchased?
It certainly is, as with the example of the 2 Chabot Street medical office building in Portland, Maine. From the time we acquired to the time we divested, it was only a 4 to 5 month period. And so we are making a distribution of capital back to investors for that investment. So it certainly is possible. However, our thesis is to buy, add value, aggregate, and sell in 5 years. But there's certainly the possibility that we could sell some assets along the way.
Wonderful. And I think we have some additional questions related to the hurdle rate. So from Mark, if it is a 6-year, if it is 6 years, is it a 10% hurdle rate per year that our investors can expect, or is that over 6 years?
That's correct. It's 10% per year. So if if an investor invested $100,000, that first year they would accrue 10% or $10,000 in accrued preferred return. and then that accrues every year. So if we sell in 5 years, let's just say that $50,000 in accrued preferred return has accrued over that 5-year period. Investors will get their $100,000 back first, then they'll get the next $50,000, and then we'll split proceeds thereafter, 80% to investors, 20% to us. So we're last in line to receive any profits at that time. But it is a 10% yearly, year over year, 10% preferred return.
Great, thank you. I'll give everyone another minute to kind of collect themselves and ask any additional questions. But on my end, I feel that I've asked everything that I have wanted to know a bit about this asset class and this particular fund. Matt, is there anything else that you would like to share while we just wait and see if there are any final questions from our audience?
Sure, we will, Gabriella, send some additional documents your way to post. One is a
Great.
one-page case study on the asset that we acquired in Houston that kind of shows the occupancy and NOI trend and some of the things we did over the last 6 months as a lender to add value. And then lastly, we did hire a third-party auditing firm to review and certify our prior experience, track record, and returns. And that should be available in the next 2 weeks. And we'll make that available, Gabriella, to you for your data room. And I think that gives some investors some assurance that a third party has reviewed and validated our experience and track record and our 28% realized IRR on prior investments, as it's hard for an investor that may be investing $50,000 to do that kind of due diligence on each asset or each potential investment that they see from you or other platforms. And so we'll make that available to investors. We think that it adds a lot of value in the due diligence process for you and your investors.
Definitely, definitely. Great. I do want to let everyone know that this deal is open until the 15th of March on our marketplaces. That said, we are looking to raise a minimum of $500,000 in capital to contribute to this fund. If we raise over that, we will be uploading a new deal on this marketplace specifically for this fund. So if we do reach that capital target before the 15th of March, we will upload a new deal to be able to allow our investors to continue to take advantage of this opportunity. Final question here from Rachel: will this fund run as explained if the 100 million raise target is not achieved?
Correct. We have already had our first closing. We have already invested money from the fund in those 2 assets. So the fund is open. We will stop raising capital this year and close the fund and invest and oversee the assets. So yes, the fund is already open. We've had our first closing.
Wonderful. Matt, thank you so much for your time today. For those joining us, thank you again for your time this evening, this afternoon, this morning, depending upon where you are in the world. We genuinely appreciate it. And please feel free to reach out again to your wealth consultant directly, to myself or to Lee Rush if you have any questions. Matt, thank you again as always.
Of course. Thank you. Appreciate it.
Take care.